It's December 2nd, 2025, the market is open, and SanDisk is behaving like a paradox you can trade. SNDK trades in the United States on the NASDAQ in US dollars in real time. The stock is roughly $207, down roughly $3, about a 2% decline. Prior close was about 210, and the open about 212. The intraday range is brutal, roughly 193 on the low and roughly 217 on the high. That kind of spread is not background volatility. It's a signal that positioning, flows, and sentiment are competing with fundamentals for control of the tape. Zoom out and you see the year-long confession. The 52-week range is roughly 28 to roughly 285. A stock that spans that much territory is still in valuation discovery, meaning the market has not settled on a stable definition of fair. Now put the hard snapshot on the table, rounded. Market cap is about $30 billion with about 150 million shares outstanding. Trailing 12-month revenue is about $8 billion. Trailing net income is a loss of about $2 billion. Trailing EPS is about minus $12. With negative trailing earnings, a traditional PE ratio is meaningless. That part is ordinary for a business coming out of a down cycle or a transition. What is not ordinary is what sits right beside it. A forward PE around 13, analyst consensus summarized as strong buy, and an average target price around $218, only around 5% above today's quote. Forward PE is not history. It is a market bet that positive earnings are arriving and will be durable enough to justify today's price. So why does the past still look damaged while the future is being priced like a profit machine? Start with structure. As a standalone listed instrument, SanDisk is new. Some market profiles listed as founded in 2024, which often reflects the legal identity of a newly independent company after separation, rather than the age of the underlying business. In market terms, that matters, because newly independent entities frequently trade erratically. The shareholder base turns over, reporting lines change, costs are reallocated, and investors have limited standalone history to anchor models. The story spine is a chain of dates that created the tradable instrument. February 12, 2025 was the record date tied to the separation. February 21st, 2025 was the distribution date. February 24th, 2025 is when SanDisk began regular way trading on the NASDAQ under SNDK as the separation from Western Digital was completed. That is when SanDisk inside a parent became SanDisk that must stand alone. To understand why the price action feels mysterious, compare what happened here to what normally happens after a spin-off. Normally, the first phase is mechanical forced selling. Parent company shareholders receive the spin whether they wanted it or not. Many institutions sell immediately because the stock fails their mandate sector exposure, size requirements, index constraints, or volatility limits. That selling is mechanical, not necessarily fundamental. After forced sellers clear, the stock stabilizes. Then management reports several quarters of clean, standalone financials, analysts refine earnings models, and only later does major index inclusion typically arrive. That slow multi-quarter digestion is how the market usually converges toward equilibrium valuation. SanDisk's sequence in 2025 was compressed. It began standalone trading on February 24, 2025, saw a major earnings and guidance proof point on November 6, 2025, and then joined the S&P 500, effective before trading on November 28, 2025, within the same year. Compression matters because it can pull a still discovering stock into index flow mechanics before ownership and valuation stabilize. When that happens, price can be driven by flows and positioning as much as by underlying business quality. Now add the narrative that accelerated the repricing. AI infrastructure. AI is not only compute, it is data pipelines. Training and inference drive massive data movement, and storage becomes the plumbing that feeds compute efficiently. NAND flash and SSD solutions matter in data centers because they shape latency, density, and power trade-offs. That is why the market can plausibly treat a storage company as an AI beneficiary. But narratives are cheap. Evidence is what investors pay for. In this dataset, the evidence moment is November 6, 2025. On November 6, 2025, SanDisk reported fiscal first quarter 2026 results. Rounded revenue about $2.3 billion, up about 20% sequentially. GAAP net income about $0.1 billion positive. Non-GAAP diluted EPS about $1.2. Management highlighted data center strength around a 30% sequential increase. Guidance for fiscal second quarter 2026 was bold. Revenue around $2.6 billion, plus or minus about $0.1 billion, with non-GAAP EPS around $3.2, plus or minus about $0.2. Now define the terms, because misunderstanding them produces the most expensive kind of confidence. GAAP earnings follow standardized accounting rules. Non-GAAP earnings are adjusted figures that remove items management argues are non-recurring or not reflective of core operations. In spin-offs, non-GAAP can be informative because separation costs can distort GAAP results. The risk is that adjustments can recur. If one-time items keep showing up, non-GAAP can overstate economic profitability. Sequential growth means quarter-over-quarter growth. In cyclical storage markets, it can signal a turning point, but it can also reverse if demand is pulled forward or pricing shifts. So the November 6, 2025 report helps explain why the market might price a forward PE around 13. But then came the mechanical catalyst that can distort price regardless of fundamentals: index inclusion. On November 24, 2025, S&P Dow Jones Indices announced that SanDisk would replace Interpublic Group in the S&P 500 effective before the start of trading on November 28, 2025. This is not inherently a fundamental improvement. It is an ownership and flow event. Normally, when stocks enter the S&P 500, passive funds tracking the index must buy them to replicate the benchmark. That demand is mechanical. The usual pattern is a run-up as traders anticipate forced buying, concentrated purchases near the effective date as index products execute, and then a digestion period once the one-time demand is absorbed. That is typical. What is unusual for SanDisk is the compressed timing. Standalone listing, then a major earnings and guidance inflection, then S&P 500 inclusion, all in 1 year. That increases the odds of a fragile ownership mix: passive holders who must own it, and event-driven participants trading volatility around the flow. This helps explain the sharp air pocket around November 20th, 2025, when the stock experienced a roughly 20% down day. In a typical large cap environment, a 20% daily drop is rare and usually tied to a major fundamental shock. In a crowded, event-driven stock, it can also reflect leverage being forced out, stop-loss cascades, options hedging feedback loops, and mandate-driven de-risking. Forced selling can produce prints that temporarily detach from intrinsic value opportunity for the prepared, and a trap for anyone who sized their trade as if the stock were stable. So the mystery is not mystical. It is a valuation gap, trailing losses versus forward profit pricing, occurring inside a compressed sequence of structural events that amplifies volatility and makes causality feel scrambled. From these facts, rational hypotheses follow. Hypothesis 1, trailing losses reflect trough cycle conditions and separation friction, while the recent quarter and guidance indicate the start of a durable profit regime. Forward PE around 13 prices normalize earnings rather than trailing damage. Hypothesis 2, the market has priced the recovery too quickly, assuming smooth continuation that is rare in cyclical storage. Volatility is the premium being stress tested. Any margin wobble or demand normalization can compress valuation quickly. Hypothesis 3, ownership is bifurcated. Index inclusion provides a baseline floor while event-driven traders probe that floor for liquidity. Wide intraday ranges like roughly 193 to 217 reflect shifting marginal price setters, now translate into actionable planning with levels. Some daily technical summaries lean bearish, often meaning price is below key moving averages or momentum is fading. A moving average is average price over a period used to smooth noise and identify trend direction. Momentum tools quantify speed of moves. After a massive run, bearish daily tone often signals consolidation or distribution rather than clean continuation. Because standalone history is short, level-based planning matters. Key shelves, rounded, current about 207. The psychological pivot is 200. Above 200, weakness can be digestion. Below 200, weakness can flip into de-risking because round numbers cluster subs and institutional limits. On the upside, the near-term ceiling is around 217 and into 218 because 217 appeared in today's range and the average target price is around 218. Strategies. Short-term, days to 2 weeks, treat this as a volatility regime. If price holds above 200 and closes stabilize, consider tactical entries around 202 to 206 with a strict risk line below 200 and a first objective around 217 to 218. If 200 breaks and fails to reclaim quickly, prioritize capital preservation. Medium term, 1 to 3 months. With S&P 500 inclusion effective before trading on November 28, 2025, the flow impulse is largely behind. The next move must be earned by fundamentals consistent with the November 6, 2025 guidance framework. Acceptance above 218 suggests re-rating. Repeated failure suggests consolidation with elevated downside risk. Long-term, 6 months and beyond. Invest only if you believe the earnings regime implied by forward PE around 13 is repeatable. If repeatable, volatility becomes an entry feature. If not, the premium compresses toward the trailing reality. That is SanDisk on December 2nd, 2025. Market open, a newly standalone equity pulled through an unusually compressed sequence February 24, 2025. Listing, November 6, 2025. Earnings proof, November 20, 2025. S&P 500, inclusion now entering the hardest phase. Not getting attention, not getting included, but defending the profit regime the market is already paying for, while the tape keeps renegotiating belief in real time. And before you go, I want to hear from you. The Valuester channel is actively waiting for your tips on public stocks, private companies, and even names that are planning to list soon, plus coin ideas you think deserve investigation. Drop your tickers and your reasoning in the comments. Tell me what you're watching and tell me what feels mispriced to you right now. Also, thank you to every listener who keeps this channel alive by watching to the end, subscribing, hitting like, leaving thoughtful comments, and sharing these episodes outside the platform. I see that support, and I pay it back with deeper research, clearer frameworks, and better storytelling. This was Valuester.